Pull out your phone right now and open your banking app. You see that balance staring back at you, right? Maybe it's $1,000, maybe a bit more. It feels so incredibly solid. You probably picture that exact amount of cash sitting quietly in some heavily guarded steel vault, just waiting for you. But what if I told you that everything you think you know about that glowing number is practically a complete illusion? Welcome to The Explainer. Today, we're going to dive right in, completely dismantle that myth, and uncover why banks absolutely do not keep your money in a vault.
So let's just ask the million-dollar question. Where is your money right now? Go on, picture it in your head. For most of us, the phrase bank vault triggers a very comforting, almost Hollywood-style image, right? 3-foot-thick steel doors, laser grids, endless shelves of neatly stacked bills. Maybe there's even a little cubby with a label that says Sarah's money or your money on it. It's a totally natural assumption. It makes this incredibly abstract financial system feel physical and safe. I mean, if you drop your coat at a coat check, you get that exact same coat back later. So obviously, we just kind of assume our checking accounts is a fancy financial storage locker.
But here is the massive reality gap between what we imagine and how the economy actually functions. That labeled pile of cash in a vault? Total myth. The reality is that your bank account is nothing more than a glowing number in a gigantic digital ledger. Most of what we actually call money in the modern world isn't physical paper at all. It's electronic balances, card payments, clearing instructions. When you hand a bank physical cash, ownership of those bills transfers to the bank. It becomes part of their resources. In return, you don't get a storage box. You get a legally enforceable promise living inside a vast payment system.
Section 1. Deposits are bank debts. The balance sheet reality.
Okay, now that we've completely shattered the vault myth, let's look at the actual mechanics of modern finance. To really get this, think about what literally happens when you slide a crisp $100 bill across the teller counter. From your perspective as the customer, that deposit is an asset, right? You have the ability to spend it, wire it, or withdraw it whenever you want. But from the bank's perspective, they didn't just get richer. They actually just gained a liability. The exact second they take your cash, they instantly owe you $100. Your deposit is their debt. The bank is essentially a sophisticated machine. It uses the asset side of its balance sheet to try and generate income, all while knowing it absolutely has to honor the liability side whenever you decide to, say, buy groceries or pay rent.
And this dynamic brings us to the very lifeblood of our entire economy, a concept known as maturity transformation. You might be wondering, well, why doesn't the bank just keep all my cash in the vault just to be safe? Think about it. If they did that, they'd just be a glorified cash warehouse. Forget earning interest on your savings, they would literally have to charge you massive storage fees to pay for the security guards, the thick steel doors, the cybersecurity grid, the whole shebang. Instead, a bank survives by taking short-term deposits, money you might want back tomorrow morning, and transforming them into long-term assets. You want instant access to your checking account? Sure. But a young couple needs a 30-year mortgage to buy a house, and a small business needs a 5-year loan to buy equipment. The bank is the bridge connecting those entirely different timelines. They live right in that risky gap between now and later.
So, to manage that risky gap, how much cash do they actually have to hold in reserve? A lot of old textbooks will tell you there's this rigid magical rule, like they have to keep exactly 10% of all deposits locked up, and they can lend out the remaining 90%. Well, get ready to be shocked. As of March 26, 2020, the United States Federal Reserve set the reserve requirement ratio to exactly 0%. Zero! No way, right? Now, before you panic, that doesn't mean banks hold literally zero cash. They definitely still hold reserves to settle daily payments, satisfy complex regulations, and control risk. But that old, dusty textbook story where one deposit automatically triggers a rigid, mechanical chain of lending, you can toss that right out the window. Today, banks are constrained by capital, by liquidity, and by trust, not by some simple, arbitrary vault ratio.
Moving on to Section 2, the twist, how loans actually create money.
All right, so if banks aren't just lending out fixed slices of the cash sitting in their vault, where on earth does the money for a massive new loan actually come from? The answer is easily the most profound, mind-bending insight we're going to cover today, and this comes straight from the Bank of England. In our modern economy, most money is actually created the moment commercial banks make loans. It sounds like absolute magic, but it's just balance sheet banking. Let's break it down. Step 1, a bank approves a $100,000 loan for a local business. Step 2, the banker does not walk down to the basement, open a vault, and hand over a briefcase full of your pre-existing cash. Absolutely not. Instead, they just expand their balance sheet. They create a brand new loan asset because the business now owes them money. And step 3, at that exact millisecond, the bank credits the borrower's account with a new deposit liability. Boom. They literally just created new deposit money out of thin air to match the new debt. The borrower can now go out and spend that brand new money into the wider economy. Money is created when lending happens, and it's destroyed as those loans are paid back.
I know, right? It is a total paradigm shift. Your bank isn't just a bucket passing your dollar bill over to someone else. It's an active balance sheet, creating a new promise and a new debt simultaneously. If this mind-bending twist just completely changed the way you look at your banking app, please take a quick second to like, share, and subscribe to our explainer. We absolutely love unraveling the hidden systems that run the world around you, and honestly, your support is what helps us keep these deep dives coming.
Section 3. The anatomy of a bank run, when trust breaks down.
Now, this whole maturity transformation system we've been talking about, it works beautifully, as long as we don't all decide we need our cash at the exact same moment. Normally, some people deposit their paychecks while others are paying rent, and the money just naturally circulates. But let's look at what happens when that assumption shatters and how that danger has evolved over time. Back in the 1930s, during the Great Depression, a bank run meant physical lines of terrified people wrapping around city blocks, banging on doors, demanding paper cash. Even in 2007 with Northern Rock in the UK, we still saw physical queues on the sidewalk. But jump forward to 2023 and the collapse of Silicon Valley Bank. The speed of that collapse was absolutely terrifying. There were no lines on the pavement. This was a purely digital run, fueled by group chats, social media rumors, and highly concentrated uninsured deposits. When panic spreads today, everyone wants their money instantly, and they want it for the exact same reason: fear. There's a brilliant saying that captures this perfectly. The vault door used to be steel. Today, the exit door is a button. Digital banking is incredibly, wonderfully convenient, but it has completely warped the speed of trust. See, a bank can be totally solvent on paper, meaning its long-term assets, like mortgages, are super valuable. But if it doesn't have enough immediate cash on hand to satisfy every single panic depositor furiously tapping transfer on their smartphone, it faces a lethal liquidity crisis. And if they have to start selling off those safe long-term assets in a panic at fire sale prices, that triggers massive losses, which can turn a temporary liquidity problem into a fatal solvency problem literally overnight.
Section 4. The invisible safety nets: capital, liquidity, and insurance.
Okay, take a deep breath. Yes, no modern bank is designed to handle every single customer withdrawing their funds simultaneously, but that absolutely does not mean your money isn't safe. There is a massive, intricate public and private architecture that's been built up over decades specifically to keep this delicate balance sheet system from collapsing. Think of liquidity, things like central bank reserves and high-quality liquid assets, as basically having enough drinking water in the kitchen to get you through today. Regulators strictly require banks to hold this rainy day bucket to survive sudden short-term stress. But a capital cushion? That's entirely different. Capital is the bank's net worth, its total assets minus its liabilities. If liquidity is having water for today, capital is having a house built strong enough to survive a severe storm. If a bank makes bad loans, its capital cushion absorbs those financial hits first, so the everyday depositors don't have to.
But you might be wondering, what happens when the commercial banks themselves run into trouble and need a lifeline? Well, while commercial banks hold checking accounts for you and me, central banks, like the US Federal Reserve, the Bank of England, or the European Central Bank, they hold accounts for the commercial banks. They are quite literally the banks for banks. They hold what are called central bank reserves, which is basically special bank money used to settle massive payments behind the scenes every single day. So when the entire financial network faces extreme stress, the central bank steps in as the ultimate emergency liquidity provider. They make sure that one single bank's temporary cash shortage doesn't domino into a catastrophic nationwide panic.
And for everyday folks like us, there is one ultimate psychological anchor keeping everything grounded: public deposit insurance. In the U.S., the FDIC provides a public guarantee that protects eligible deposits up to $250,000 per depositor per insured bank across various ownership categories. This is honestly genius because it drastically simplifies trust. As a small depositor, you don't need to spend your Friday nights analyzing a bank's complex stress tests or combing through balance sheets. Deposit insurance loudly tells households, hey, you do not need to race down to the branch and empty your savings the second you read a scary rumor online. It completely breaks the psychological fever that causes a bank run in the first place.
Section 5. The real vault is trust. Concluding our explainer.
We've journeyed way past the myth of the heavy steel vault today. We've seen how loans actually conjure money into existence, and we've examined all those invisible safety nets keeping the tightrope walker aloft. But what is the actual structural foundation of it all? As the saying goes, the real vault was never just steel, it was trust. Modern banking is ultimately a sprawling network of promises stretched across time. You trust the bank will honor your withdrawals. The bank trusts that borrowers are going to pay back their mortgages. Regulators trust the complex math, and depositors trust the public insurance. Your money might look perfectly still, just a frozen number on your smartphone screen, but behind that glass, the entire system is constantly moving. It is vibrating with millions of interconnected promises. Banking only works because we all collectively believe the promise will be honored, and we've purposefully built institutions to make sure that belief is rational.
So, as we wrap up, I want to leave you with a final, provocative thought. Take out your phone, look at your banking app one more time. You aren't looking at a locked box of paper bills. You are looking at a living, breathing network of human trust. But if money is really just a fragile network of trusted promises, what actually happens the exact moment we all stop believing in them? Thank you so much for joining me for this explainer today, and stay curious out there.